Good afternoon, everyone, and welcome to this Kepler Trust Intelligence event entitled Growth at an Unreasonable Price. It will not be lost on anyone that it hasn't been a great year for markets, but we can't buy the past, only the future. So with that in mind, we've gathered a number of growth managers together to talk about where they find the best prospects for investment returns in the coming years. Shortly, we'll be hearing from Stephen Paice, Head of European Equities, Baillie Gifford. Stephen will be talking about Baillie Gifford European Growth Trust. In this market sell-off, the trust has slipped onto a discount of 14% as of yesterday, so potentially interesting for anyone looking for a good entry point. Just by way of a reminder for those of you who, or new information for those of you who haven't been in one of our presentations before, we will have a Q&A at the end of the session, so if you could put your questions, if you could write them into the box that should be on the right of your screen, then I will gather those and put those to Stephen at the end. We hope to have around 50 minutes or so for questions at the end of the presentation. So with that, over to you, Stephen.
Okay, thank you very much for the introduction, and I'm very happy to be here. Let's start. I mean, just for context, at Baillie Gifford, I manage a team of 9. We invest about €4.5 billion across a number of different vehicles, with our longest track record going back to 1985. So we have seen our fair share of market cycles. And over that time, we have obviously evolved. And effectively, our process and philosophy is still the same. We're trying to identify and invest in the best companies or the best growth companies in Europe, and hopefully hold those as long as possible. Now, as you will have heard, as you will know, we are facing a very difficult environment for consumers, society in general, for companies, for our clients, for managers. We have an ongoing war in Ukraine, and we're facing the second order effects. We've got rampant inflation, we've got the prospects of a likely recession, and longer term, as you can see from this chart on the right-hand side here, Europe seems to have been left behind by more innovative and growth-orientated regions, so much so that, if you can see the axis here, since about 2010, Europe's share of global market cap has fallen by around 40%. Now, I could go on and speculate about what might happen with interest rates and inflation, but the truth is, investing is all about insights. And we're not going to, I think, add much value or insight to speculating about some of these well understood and likely priced in issues. Where we can really have insight is investing in Europe's future, and a future that looks increasingly cheap, or as the title of the day is, unreasonably priced. And when we talk about kind of thinking about Europe's future, I mean, this is what we're trying to do. We're trying to find the best companies. We don't have to invest in the European economy. So you can be positive on companies, but still have a negative outlook on the economy. And what we're trying to do is identify outliers. And to us, outliers are these companies which exist in Europe, which have large structural growth opportunities, some of which I'll come back to later. The average implied or expected revenue growth rate over the next 3 years for our portfolio is about 19%, and this compares to the index of about 8%. So the companies that we invest in are growing much faster. They're also able to expand margins and returns, and they have very strong and improving competitive positions. And they typically have meaningful inside ownership in the form of an exceptional founder or a multi-generational family who may be on the board and influencing capital allocation decisions. And about 85% of the portfolio would be in companies with families, founders, or significant insiders. And I think that helps. It particularly helps with resilience. And when we're going through quite volatile market conditions, having that long-term family or founder presence means that companies are typically run in a slightly more resilient way. They tend to continue investing in growth. They tend to have slightly more conservative balance sheets. So if you looked at net debt to EBITDA for the portfolio, it's about 0.7, and this compares to about 1.4 for the index, so about half the level of debt or net debt to EBITDA that the market has. And those types of characteristics are the ones that we find consistently in the companies that are able to produce returns of 2, 3, 5x over a 5-year period. And this is what the distribution chart on the left-hand side there. And I think there's still a belief that in Europe, we don't really have these types of companies, or the likelihood of finding and investing these outliers that go on to produce these huge returns is particularly attractive. However, what we've seen from what we've kind of compared different regions, and the probabilities of finding companies that go up at least 2x over a 5-year period in Europe is pretty much the same as it is in most other regions. It's pretty much the same as it is in the US. It's just that the composition of the European market is very different. Now, that kind of 30% number is a long-term average. What we've also seen is that the starting point matters. So if you were to go back to the peak of the market in 2007, I think there were probably 10% of companies at that point that then were able to go on and double in value over the next 5 years. If you roll forward to then 2008, 2009, and again, very similar to today, where the consumer confidence levels were completely beaten up, everybody thought basically the only way was down. There was lots of negativity in the market, but at that point, 40% of companies in Europe were then able to double over the following 5-year period. Now, I'm not saying that's exactly where we are today, but the probabilities have substantially increased purely as a result of the multiple compression that we've seen. So I think that the point here is that please don't forget that despite the kind of the top-down perception, despite kind of the challenges the European economy faces, there are lots of opportunities for long-time growth investors to make a lot of money over time. And when we think about kind of where do these outliers come from, now you will understand that we're not trying to spend all our time predicting inflation or interest rates. We're not trying to build portfolios of slightly better than average companies. We are looking for pretty special outliers. And it's much easier to do that when sentiment is as negative as it is today. And I think I saw recently a stat that said that we have seen, and this is the Europex UK asset class, but we have seen consecutive weekly outflows from Europe since the middle of February. And that is the longest consistent period of outflows on record. So I think, as I said, a lot of negativity, but this is why we're perhaps a bit more optimistic when we think about the future and the types of businesses that we invest in. And even if you were to go back 20 years to 2002, when again, the environment was very similar, lots of kind of negativity. But if we had a kind of crystal ball and perfect foresight for what was going to happen over the next 20 years, despite the recessions, despite the Afghanistan and Iraq wars, despite the pandemics and the housing market blowing up and everything else, there were some fantastic companies that we could have invested in. Some of them we did. We had a CIE Automotive in Spain, which is a Spanish auto parts company that went up 30-fold. In Switzerland, we've got companies like Sika, Temenos. Germany, I mean, you have companies like Sartorius that we invested in like 5-6 years ago, that has increased in value 500 times over the last 20 years. You've got another company called Nemetschek, which is a construction software business, which appreciated in value 250 times. Now, what's the point of pointing these or name checking these outliers? It's because they all have the same characteristics. They were all growing much faster than the market. They were much more innovative. They were mostly family or founder run, and they were relatively small. And these, I think, are probably what are called the hidden champions of Europe. Now, again, the other point here is to reiterate that to be able to capture these massive value creation stories, investors need to remain optimistic and be willing to hold on to their winners. And I think that's even more important to talk about that today. Now, of course, our mission today is to find the next generation of big winners. And I think there's probably 4 areas that I can talk about, which I think will be quite productive in that sense. And the first one is decarbonisation. We have a number of companies involved with this in Europe. We have serial acquirers, which I think Europe has some of the best companies that are able to consolidate pretty fragmented markets. We obviously have lots of tech companies trading at very distressed multiples, and we have transformational healthcare. Now, I'll talk a bit about each of these in turn. I'll probably spend a bit more time just in terms of interest of time on decarbonizations and maybe the valuations in tech. But when we think of decarbonisation, and again, if you think back over the last couple of decades, some of the biggest investment themes have been obviously the TMT bubble. We've had Chinese industrialization, we've had rising incomes following that, and of course, network effects and big tech. But I think probably one of the biggest, if not the biggest theme over the next coming decades will surely be climate change and decarbonisation. And the energy crisis that we're facing just now has only really accelerated this trend. And I think Europe is in a pretty special place here to be able to carve out, hopefully, a leading position. And Europe as an emitter is the third largest carbon emitter on the planet. But I think because of the Green Deal and the Fit for 55, where it's increased its reduction targets to 55% by 2030, and hoping to get the renewable mix up to 40% from 32 by the end of the decade, it's showing that we're trying to lead that race to become net zero, and hopefully helping to pull along a lot of the other regions as well. And obviously within that European mix, we have some countries which are being a bit more proactive and ambitious in terms of what they're hoping for. So Sweden has a net zero target for 2045. And we also have some of the strictest emissions laws. And I think all of these things are helping to create industries which can enable this transition. And then, of course, there is the huge amount of capital needed to fund this transition. And it's expected that some of these areas will require up to $2 trillion US dollars by 2025, but the IPCC thinks it's probably going to be double that. And the 5 largest areas within this would be EVs, biofuels, HVAC, smart grids, and wind power. And unsurprisingly, Europe has a number of potential outliers in these areas. And some of those companies include Northvolt. Northvolt is a private company. As you might know, we have the authority to invest up to 20% of assets in private companies. But Northvolt, using some very low cost hydroelectric power in Sweden, is hoping to produce the cheapest and most sustainable batteries on the planet. And it's expected to produce about 250 gigawatt hours by the end of the decade. Now, there's clearly lots of Asian competition, but we're seeing increasing signs of European protectionism. European companies like the OEMs, the car OEMs, society, and all the politicians want to have a European battery champion. And I think Northvolt has probably got the best chance, certainly in terms of the funding, to be able to provide that. But then you have companies like Nexans. One of the biggest winners over the last 20 years is another company called Neste Oil. And some of you might know this, but Neste is a Finnish company and was able to pivot basically away from being a slightly more traditional oil refiner and to build up the world's largest kind of renewable diesel business. And because of that, generated some quite terrific returns for investors. And we think Nexans may be able to do something similar. It has a number of commoditized cabling businesses which are involved with autos, construction, but the real attraction here are the cables required for electrification. And these cables, most notably, are required for high voltage subsea connections, connecting offshore wind farms to the grid. And there are only 2 companies in the world that can manufacture and then lay these copper cables at depths of up to 2 kilometers and they both happen to be European. So I think Nexans is another example of a company that's going to be able to benefit from some of these structural trends, which is trading at pretty attractive or unreasonable valuations. And then we've got plenty of other ones. I mean, in the fund, we probably have about 20% exposed to this particular thematic. We have companies like NIBE, which is one of the largest manufacturers of energy efficient heat pumps in the world. So I think that when we look back in 20 years, it's some of these companies that have the opportunity to tap into this market that are going to be on that list of big winners. Now, what else do we have in Europe? We have some slightly less sexy businesses. So we have, as I said at the start, some of the best industrial consolidators on the planet. And these typically operate in pretty unglamorous industries. But again, consistently, we see the same characteristics. They are typically decentralized when it comes to their organizations. They operate in very fragmented markets. They're asset light and they're very cash generative. So we have companies involved in freight forwarding like DSV. And as a freight forwarder, this basically arranges shipments we've made to be, whether it's through air, over sea, or roads, very asset light. But even as one of the largest third-party freight forwarding businesses in the world, DSV only has about 4% market share, and it is probably the natural consolidator in this market. IMCD is very similar. It's a specialty chemicals distributor. Again, it acts more like a consultant. So it's asset light. It doesn't own its own warehouses. It outsources logistics. And again, like DSV, despite being probably the largest pure play specialty chemicals business in the world, we think it's probably got 3% market share. So again, decades of room to grow, and it has the balance sheet to be able to do that. Topicus is slightly different in that it operates in vertical market software. Again, this is a pretty fragmented market, but the underlying growth strategy here is to consolidate these markets. So I think regardless of what industry these companies operate in, they're able to, when we go through periods of weakness, take advantage of weaker competitors and build scale or build increasing scale through acquisitions. Then we have healthcare. Again, when we're going through this kind of cost of living crisis, we're dealing with COVID. I think investors and the general public forgets just how remarkable the progress in life sciences has been. And you only have to look at companies like BioNTech, Moderna, AstraZeneca, and what they did with the vaccine was pretty incredible. Now, Europe has a number of world-class research institutions and hospitals. It is home to 16 of the largest and best universities for life sciences and publishes roughly the same number of articles in the top 10 journals as the US, and about 3 times as many as China. Now, Europe's strength as a global powerhouse for scientific research hasn't really translated into patents for new medicines, for instance. And I think this is partly to do with funding. However, things are changing. We have companies like CRISPR Therapeutics, and this is a company we bought recently, taking advantage of this huge sell-off in growth assets. And this was co-founded by Emmanuelle Charpentier, who was a Nobel Prize winner. She won the Nobel Prize. She was recently, it was quite recently, she was the co-inventor of the CRISPR gene editing tool, which basically can cut and add segments to your DNA. And with this technology, I think they're able to transform the lives of patients with very serious disease like sickle cell and lots of different blood cancers. And again, it's important to reiterate that we had looked at this before, and because of the severe sell-off, we were able to take advantage of that and add a new position to the fund. Evotech is another one. This is a contract research organization, and this is a kind of a slightly different take on life science innovation, whereby a lot of the, if not all of the largest pharma and biotech companies are outsourcing their preclinical research to specialists. And within that, Evotec is the clear leader, we think. And it's also on the side developing its own pipeline of therapeutics, which is co-developing alongside these pharma and biotech companies. So over time, it's going to be able to benefit from kind of a cash generative CRO business, but take advantage of a royalty and milestone pipeline, which over time should create significant value. And then we have companies like Sartorius Steadin. Now, we like investing in picks and shovels in certain industries, and I think Sartorius Steadin, being one of the best performing companies in Europe over the last 10 or 20 years, is a good example of that. And this is a company which manufactures single-use bioprocessing equipment. So instead of using huge stainless steel vats to basically boil up and manufacture drugs, it manufactures single-use fermentation bags and equipment which are only used once. And for the customer, this not only lowers the probability of contamination, but as an OPEX rather than a capital outlay, it's actually much cheaper. So this is one of the reasons why it has done so well over the last 10 or 20 years. But we see, again, significant growth here from market share gain and increased penetration rate. So I think that if you're starting to look at healthcare in Europe, things have started to change for the better. And then finally, we have European technology. Now, the last year has been particularly brutal for genuine active growth managers. And I say genuine because I still think there are lots of investors out there pretending to be active and pretending to be growth investors. And what we've seen from inflation and obviously quantitative tightening, we've seen something of an indiscriminate sell-off in European equities. But I think the pain has been most acutely felt in long duration and innovative tech platforms. But there are two broader points here. And the first one is going back to this point where the backdrop in the environment for European tech companies to flourish has never been as good and as supportive. And the opportunity set for us has completely changed over the last 5 years ago. We have had companies like Delivery Hero, which listed in 2017. We've had, even in the UK, Farfetch, Spotify, Adyen. These companies all listed in 2018. We had Prosus, which is Europe's largest tech holding company, listing in 2019. And technology is a component of the European index. It's gone from about 9% to about 20%. And I don't need to tell you about all the stats on the number of unicorns that were created last year and everything else, but the environment is just much richer and much better now for long-term investors. And I think we've also seen a completely different level of ambition that we haven't seen in Europe for many years. And I think having some of these role models is showing some of those smaller startups in the private markets that Europe does have what it takes to build world-class and global leading digital and technology champions. Now, we've had examples of HelloFresh, which is the meal kit operator, move to the US and basically wipe the floor with the competition there, particularly with the Blue Apron. We've had Spotify, which continues to take market share. Delivery Hero, I mean, this is pretty much number one in almost all of its markets now. It's almost a monopoly, particularly in the Middle East and Southeast Asia. And we have Schibsted and its underlying company Adevinta, which are now the world's largest collection of online classifieds businesses. So I think these are great examples of what Europe can offer. Now, when it comes to kind of the second kind of broader point, we have that extreme drawdown that we've seen in multiples, and we've not seen such a rapid and vicious compression in valuation multiples, which has happened over the last year, probably since the 1970s. And when it comes to valuation, we're trying to assess the probability of the company at the current time being able to at least double over the next 5 years, we're also looking at what the outlier scenario would be. How can we make much more money, and what needs to happen for that to transpire? And then we're thinking about the variant perception for these companies as well. We're looking at reverse DCFs to see what has been priced in when it comes to the implied growth rates and margins and reinvestment rates. And I think taking those as a component of our portfolio, and we have probably 25% of our portfolio in companies like this that have fallen in value by more than 50%, despite the outlook for these companies not really changing. Yes, Zalando has seen its multiple compress viciously, and it has seen the near-term growth rates slow down, which is inevitable given the pressures in the consumer and the kind of the roll-off of the COVID period. But for companies like Zalando, which has probably 2% market share, there are not many investors out there looking at what it might look like by the end of the decade. Zalando is profitable, but we are thinking about whether it can go from low single-digit operating margins to 10% plus and become 5 times as big by the end of the decade. So again, trying to take opportunistic views on these companies. We have companies like Delivery Hero, which has fallen, almost 2/3 of the last year. And this is another company which has seen its valuation multiple. If you look at sales, fall from about 7 times sales to about 1. People are worried that Simply Delivery Hero is unprofitable at the moment, but we have now seen that about 70% of its GMV is profitable. And in areas like food delivery and auto classifieds and a number of other tech markets, we're seeing a lot of competition come out. I think the era of cheap and easy capital flooding into some of these areas is no longer there. And particularly for companies like this, they are going to benefit from this retraction. And the pathway to become profitable is, if anything, speeded up from here. So we're much more comfortable now that companies like Delivery Hero do have a viable business model. They are going to be profitable. And this simply hasn't been priced in. But even within this segment of the market, which has seen its valuations and share prices collapse, we have lots of very profitable companies. Within Europe, we have Schibsted and the online classifieds businesses. These companies make 30% plus operating margins. We have Adyen, again, fallen more than 50%, which makes 60% margins. Zalando is profitable. We have Allegro, which is it's effectively like an Amazon type business in Poland. And again, extremely profitable. So I think we're in a stage of the market where we've seen the sell-off going from something which was quite logical, because when you have higher rates and higher discount rates, a part of that drawdown is to be expected. But I think the sell-off has gone too far, and we're now being given the opportunity to invest in some completely unreasonable prices. And I don't think these business models are broken. And in fact, I think they're just getting started monetizing what are pretty dominant positions. Now we can come back to performance in a bit more detail if you would like. I mean, the high level comment here is that the share price of the trust and NAV growth has been pretty disappointing over the last year. Again, you can see here, but we've clearly underperformed, and we're not happy about that. But we're trying to remain optimistic and rational about what kind of value and opportunities we can deploy our capital into to make our clients and shareholders lots of money over the next 5 or 10 years. And I think you've seen what has been quite an extreme period of underperformance. And you can see this by looking at the 1 year, 3 year, and 5 year rolling performance charts. And this is going back a decade for our European fund, which we've been running since 1985, which is obviously a much longer investment track record. And you can see it in terms of how extreme that 1 year performance has actually been, and that affecting the 3 and 5 year numbers. Now, I can't time the bottom of the market. I don't think anybody can, But I think from here, the probabilities of being able to achieve the types of returns that we want and the performance that we want is much, much higher. So I think that's pretty much 30 minutes. I think just going back to that kind of summary, yes, there are certainly dark clouds over the European economy, but we don't have to invest in the European economy. Just the very best innovative companies that are capable of producing quite extreme returns over long periods of time. And the title of that very first slide, the point, it was the Jean Monnet quote about Europe being forged from crises. I mean, that's probably one of the most overused quotes when looking at Europe. But I think for an investor, Europe is really the sum of its companies that are able to provide solutions to some of these crises. And on that front, I think Europe is still very much misunderstood and overlooked. And I think that's one of the reasons why it makes it such a great place for long-term bottom-up growth investors. So I'll maybe stop there and see if there's any questions.
Thanks very much, Stephen. We have had a few questions come in, but there should be plenty of time if any participants want to add their questions, please do on the right. So there's a few questions around, I guess, negativity, but maybe we could start with a positive question. So as you survey the portfolio now, I think you said that you're looking for a minimum of doubling your money over 5 years. Which companies are you most confident, your company or companies are you most confident will be able to achieve that from the current moment?
I mean, that's really the hurdle rate. And what we've gained a much better appreciation of is that stock markets and portfolios, the outperformance is driven by a relatively small number of companies. And we've seen that when we disaggregate the returns over many years, a much longer time frame than most investors look at. But that's ultimately what we're trying to do. We're trying to invest in outliers. So that kind of 2x or doubling over a 5-year period is really the base rates. And as I said, even if you picked a company at random over the last 30 years, you had a 30% chance of identifying one of these companies. So that's really the starting point. But ideally, what we're trying to find are those companies that go up 10x, 20x, 40x, because these are the ones that provide the outperformance. And when we look back over the last 10, 20 years, we have had a number of these outliers in the portfolio which have produced spectacular returns and generated large positive attribution for the fund. So Atlas Copco is a great example. Over the last 20 years, Atlas Copco has appreciated in value by almost 40 times, or it's a 40 bagger. And one of the hardest things to do when you have companies like Atlas Copco is not to sell them. And that's what we're trying to do. We're trying to identify these special businesses and hold on to them for as long as we can. And we have quite a diversified mix of companies that we feel pretty comfortable with generating at least a 2x upside over the next 5 years. But we're trying to think about what happens after that as well. And you can see some of them here. I mean, I've already mentioned some of those sold off tech names. We have some of the online classifieds businesses, which again are just at the start of the transition within the classifieds market by being able to capture more of the transaction. They're not just simply acting as listings for cars or jobs or houses. These are platforms which are going to be able to move into whether it's financing and insurance for the auto market, or moving more into finance and insurance again for homes. These are really profitable businesses that again have decades of profitable growth ahead of them. So I think for some of those tech companies, I think the future is very bright. But we could go through every single one of these companies. The point is that we systematically go through the valuation approach for every single company in the portfolio, and we systematically reassess what we think the probabilities of doubling in value over a 5-year period or doing even more. And every single company in the portfolio has a much better than average chance of being able to do that over long periods of time. Now, going back to that kind of first question that's up there, this kind of approach sounds quite appealing, but that hasn't been reflected in share prices in the near term. Now, what happens in the near term, the share price of a company over short periods of time is driven by the valuation multiple, which in itself is driven by behavior and emotion and sentiment. It has very little to do with underlying fundamental and operational progress. When we think about value creation over 5, 10 years and beyond, it is growth in cash flow, in earnings, returns on capital, and corporate cultures, which are the most important aspects of value creation. The multiple and the valuation component over longer periods of time is very small. So this is why this approach doesn't seem to be reflected in the share price today, because we've had this extreme sell-off, which is partly related to discount rates, but also partly related to panic and this kind of top-down perception that we don't want to invest in anything European, and certainly nothing to do with growth in Europe. So again, I think that's one of the reasons why we feel quite optimistic.
So you mentioned the impact of interest rates on valuations. We have a question here about to what extent is that already priced in? So two parts to the question. What does the market currently expect European interest rates to peak at? And to what extent do you think interest rate increases are already priced in, or maybe more than priced in?
Yeah, the real answer is that I don't know what they may peak at and when that peak will be. I think the consensus believes that interest rates in Europe are going to be lower than those in the US. I think the structural reasons for inflation in Europe are more related to energy and food. I think there's something structural with the labour market in the US, which means that the Fed may have to tighten faster and longer than in Europe. But that's certainly what the consensus numbers are implying, topping out, I think, 2.5%, 3% interest rates. But what we're doing is factoring this into our valuation models and applying 10% discount rates when we're looking at the DCF models. And when we're doing that, we are now seeing most of the companies become ridiculously cheap, actually. I mean, there are some companies in the portfolio that the implied growth rates, the implied ability to generate above WACC returns is limited. So there's something not quite right. And you don't get many opportunities like that to take advantage of structural mispricing in the market. So I think that's what we're trying to do. Now, again, what's going to happen with interest rates from here, we're not entirely sure, but what we're also trying to do is make sure that we have a resilient portfolio and we don't like taking on too much debt at the company level. And none of the investments that we make we think have any kind of issues with debt. Now, if an interest rate environment does become a bit more protracted and aggressive, you do not want exposure to companies with leverage and inefficient balance sheets, or not inefficient balance sheets, but well, basically lots of debt. And I don't think we have that in the portfolio.
So is that true of the tech companies that you highlighted too, that they're generally speaking, it's not, you have no worries that they'll need to refinance at higher rates? Yeah.
This has been one of the worries for companies like Delivery Hero, but as I said, they have businesses within the group that are profitable. They also have lots of cash and other assets that if they wanted to, they could sell off. Now, that I don't think is going to happen, but we've gone through every single company looking specifically at that question. We've looked at some of the airlines we have as well. Wizz Air is maybe one of the other ones which people or investors think about in terms of balance sheet. But for us, we are pretty comfortable with all of these. And if you have companies that are trading like they are in severe financial distress, then If they're not, which we don't believe they are, this is giving us a remarkable opportunity.
We have a very specific question about Delivery Hero. So management expectations for earnings implying very high operating profit margins of over 20%. Do you believe that? Do you believe management? And if so, why?
Whether they can get to 5 to 8%, and you can convert the GMV number to EBITDA by the commission rates or take rates that they have. But yeah, we're looking at something over 20-25% underlying operating margins. Now, whether you look at Delivery Hero or whether you look at Just Eat Takeaway, particularly with Just Eat Takeaway, in Northern Europe, they already have businesses and regions which generate 7% EBITDA to GMV. So we know that there are food delivery businesses out there that generate extremely attractive operating margins. Now, you have to then think about the structural reasons for that. How much market share do they have? Is it monopoly? Is there much competition? What is the split between high margin marketplace, kind of GMV, and slightly lower margin food delivery? But I think when we're looking at these factors and looking at the types of market share that Delivery Hero now has within these markets, we feel quite comfortable that, again, the direction of travel for the entire group is positive. And I think for the first time ever, they broke that down in the recent presentation and showing that 70% of their GMV is actually profitable on an operating basis, not on a free cash flow basis. That will come in a couple of years. So we're giving them the benefit of the doubt because we've seen this model work and we believe in the model.
In the sell-off that we've seen, have you noticed, you mentioned there's a lot of your existing portfolios looking very cheap. Have you found other opportunities in companies that were too pricey beforehand? And related to that, have you seen portfolio turnover pick up over the past year as a result?
It's probably ticked up a little bit. We're probably closer to kind of the 25% level, whereas we have kind of a long-term, not a target, but we would like to see kind of turnover between 10 and 20% because that reflects that 5 to 10 year average holding period. And we have taken advantage of the sell-off. So we've been adding to things in the portfolio that we know very well. And I think that's one of the best things that investors can do. But we've also taken advantage of companies, particularly when it comes to the kind of the healthcare and biotech sector. I mean, we don't have a big exposure to biotech, but we're able to take a holding in CRISPR Therapeutics. And in fact, the CEO is in the office now, so I'm going to pop there and see him after this. But that was a company that, on a market cap basis, last year had a value of close to $12 billion US. It fell to 3 or 4 billion. And that was purely because of discount rates, expectations of interest rates going forward. It had nothing to do with operational progress. And they are now closer to commercializing their first drug. And again, completely dislocated to most other economic and industrial worries that are out there that are affecting most of the markets. There's some question marks over R&D and funding for biotechs, but CRISPR Therapeutics are very fortunate to have a very strong net cash position as well. So they don't have any issues with funding. So when you see kind of biotech companies like that sell off so extremely, then again, we're taking the opportunistic view that we're picking up these unreasonable prices. Evotech, as I mentioned, was one of the other ones where the last time we looked at it on an earnings basis, I think it was trading at 100 times earnings or forward earnings. That multiple has collapsed again. But within that business, you have a cash generative CRO business, but optionality by hitting it big with some of its drugs or kind of early stage drugs in its pipeline.
We've got, if anyone wants to quickly rush in a final question, this is your last chance. We've had a question about earnings. So with Europe being on the brink of recession, obviously we've spoken a fair amount about valuations and so forth. But in terms of earnings, given the economic outlook, how comfortable are you that the companies in your portfolio can grow their earnings in nominal and real terms in the next 2 to 4 years?
I mean, this is the next stage of where we are in the cycle. We've seen this vicious sell-off in valuation multiples. So I think that's already happened. And what we're going to see from here is quite a extreme reset of earnings for most of the European market. I don't think there is much likelihood that Europe or the European companies are going to be able to grow earnings at the rates which are still predicted. I don't think anyone believes that, and this is why share prices have already sold off. Now, that's started to be worked through. I think that will be more apparent in some of those economically sensitive businesses, banks, particularly energy companies, where we're going to see a huge value or an earnings reset for most companies. And we've looked at this for all of the companies in the portfolio as well. And again, you are going to see a period of slower growth, certainly for almost all companies. However, what we're trying to do is identify those companies where the longer term earnings profile has not been factored in. Because when you think about, let's take a 20 or 30 year DCF, each year of earnings, certainly in the near term, constitutes a relatively small part of a company's value. So even if one of our companies didn't produce any earnings in the next year, it has a very small impact on the net present value. Now, what we're trying to identify are those companies where the earnings profile and the margin profile in terms of the direction of travel is positive, and identify all those other companies where they have such strong balance sheets they can start acquiring distressed companies. Now, that doesn't sound that optimistic, but that's I think the reality that we're in, certainly when it comes to Europe. But we have in the portfolio a set of companies which generates a significantly higher proportion of revenues and profits overseas and out with Europe, not that inside. But I think certainly we're more confident in the earnings profile of the companies in the portfolio than we are of the overall European market, which I think is going to see quite big earnings revisions downwards.
Brilliant. Well, thanks, Stephen, for answering those questions, and thanks very much for your presentation.
No problem at all. Thank you very much for the questions.
Thank you to the participants for your questions and for your attention. And we hope you can stay on and join us to hear from Stefan Grease, BlackRock, as well at 1 o'clock. Thanks very much, Stephen. Bye-bye.
Thank you.